Hello everyone, my name is M. Kumar. Today I will be talking about Indian banking system, principles of banking, and rules and regulatory frameworks of banking system. Indian banking system is one of the oldest, robust and well-regulated banking system. Indian banking, as on record, established as first bank as in Bank of Hindustan around 1700s, followed by Imperial Bank of India, Indian Bank, Punjab National Bank, Bank of Baroda, Karur Vysya Bank, Sri Union Bank, etc. During the Indira Gandhi regime in around 1969, many bank has been uh, made as a public sector banks under bank nationalization scheme, and Indira Gandhi has made around 15 public sector banks during that period. During the recent Modi government, many banks has been consolidated and merged as a single big banks, and under the Basel III norms during as SIB policies and all. As on date, the total number of public sector banks is around 13. Private sector banks around 21 private sector banks are there in India. Around 19 small finance banks are there, and around 1500 urban cooperative banks are there. RBI has mainly classified Indian banks as scheduled commercial banks and non-scheduled commercial banks. RBI is the Central Bank of India, which is cooperated under Reserve Bank of India Act 1934. RBI regulates all the banks, acts as a central bank to government and lender of the last resort. Every bank that in India has to maintain CRR and SLR with the Reserve Bank of India as their reserves. CRR is nothing but cash reserve ratio. Cash reserve ratio is the cash reserves that bank has to mandatorily maintain with RBI as a percentage of their net demand and time liabilities. Same as in SLR, that is statutory liquidity ratio, in which bank has to maintain their reserves as a liquid asset in a form of liquid securities, government bonds, etc. As present, the CRR is around 4.5% and SLR is around 18%. RBI also regulates the liquidity through its monetary policy, through repo rates and reverse repo rates, bank rates, marginal standing facilities, etc. Repo rate is again a repurchase agreement through which RBI lends to the bank, and it is being mandated to the banks that all the loans, that is assets, all the loans has been benchmarked as a repo rate, as the interest rate has been benchmarked with the repo rate. Now we uh, talking about the frameworks. All the bank has now been mandated by the international union, that is through the Basel record, to maintain as per the Basel norms. Basel norm came around 1988 as a Basel 1. It is mainly to avoid the bank runs and improve the qualities of asset in banking setup. The Basel 1 is uh, basically is about the minimum capital requirement, and it allocated the asset as per the bucket of 0, 10%, 50% and 100%. But it unable to classify the risk weighted asset that is being assigned to the asset. So next improvement came as Basel 2 around 2003, which involves three pillars, that is minimum capital requirement, supervisory review process and market discipline. Minimum capital requirement is that we are going to talk about is the capital adequacy ratio, and capital CRAR, that is capital risk to asset ratio. Capital adequacy ratio is the minimum capital that bank has to maintain as per the Basel norms, and capital adequacy ratio is nothing but total capital of the bank divided by the total risk weighted asset. Now, what happens is total capital of the bank is divided into three categories like tier 1, tier 2, and tier 3 capital. Tier 1 capital is the cash and cash reserves and equity. Tier 2 is all the loans and their preferential shares, non-preferential cumulative shares, bonds, etc. And risk-weighted asset is now all the asset has been classified under three major categories of risk like market risk, operational risk, and credit risk, and all the asset has been weighted, and all the asset has been given weightage accordingly, and then we calculate DCRAR, which Basel says has minimum of 8%. Now RBI has mandated every bank has to maintain 9%. But after the Lehman crisis, around 2008 crisis is well known, Basel came with around Basel 3 norms and added three more important modifications to avoid the bank runs like that, which involves the capital conservation buffer that every bank is to maintain additional 2.5% of its capital, liquidity coverage ratio, which is also as a leverage ratio, that bank has to maintain a high liquid asset of minimum of 1 month of requirement to avoid any bank runs or any kind of bank losses if anything happens, and net stability funding ratio. Also, the RBI has mandated banks to regulate the NPA profiling, that is non-performing asset, and all the it is mandated that every bank should have gross NPA lesser than 10%. If it is not lesser than 10%, then in RBI puts the bank in provisioning controlling PCR, that is provisioning controlling norms, in which banks are not allowed for doing any funding operations and reducing their net. So it's a very good parameter for a banking system to have a good CASA ratio, credit to deposit ratio, and gross NPA should be lesser. Credit to deposit ratio is nothing but the credit to its net deposits. It is ideally it should be around 80% now, and RBI also mandate to keep the bank credit to total deposit ratio under 80%. I hope this video will be useful to you on the basics of banking. Thank you.